Okay, great. Well, thank you so much for everybody logging in today. I know we've got a good crowd visiting with us today. Welcome to Finspire's Focus on the Market series. This will be our last video update of 2020. And joining me today, we've got Garrett Melson, who's a portfolio strategist with Natixis Advisors. And we are going to spend the next 30 minutes plus or so hitting the high points and low points of 2020 and giving you not only a recap of what's happened in the markets, but also what to look forward to in 2021 as we close out this very interesting year of 2020. You can see we've got the boxing gloves out here on display. That's because of course, the biggest headline of 2020 clearly was the fact that Mike Tyson can still box, and that is the biggest news item of the year. Oh, sorry, I've already been corrected over chat that it's not true. So we'll get down to business. Garrett, it has been quite the year, but what's interesting is we entered this fourth quarter with some clouds of uncertainty, right? We've had of course, an economic recession, deep economic and short and brief recession, followed by a significant and sharp economic rebound in a corresponding market rally. We entered the fourth quarter after that rebound with some uncertainty about where the election results were going to come in. Perhaps we're still counting votes these days, and that election season, of course, is going to continue right into early next year. We came in with question marks about how perhaps the second wave of coronavirus cases around the country and around the world were going to impact global, U.S., and even local economic growth, and everything else thrown in the mix. So why don't we get to it and do a quick recap as to where we are, because we have seen a significant surge in the fourth quarter, especially in the global equity markets. What does your research show you is where we are today?
Yeah, great. Well, first of all, appreciate the introduction there, and thank you very much for the time, and thank you all for joining us. Really, it has been, I think Chris covered it, quite the year. Even just past quarter, it just feels like, on a daily basis, we're drinking from a fire hose of information. That kind of sums it up for me, at least for the year. And, I think it's easy to lose perspective on just based off how quickly things have evolved this year. So taking a moment to just take a look back at really what we've been through this year, I think it's unbelievable to imagine that, just a couple of months ago, we saw the quickest and most extreme bear market really in the history of our markets here, drawing down about 35% in a matter of 20 days. Really unprecedented, nothing that we've ever seen before. And it's really incredible as we start with this first slide here. If you take a look at equity market performance across the board, it's been a really strong year for markets. You just take a look at, the NASDAQ and U.S. growth in particular. That's an area of the market that has really benefited from the dynamics of this crisis. I'm still working in my home 9 months later, relying on technology, as I'm sure many other Americans are. The only things that we can actually go out and buy are generally, goods instead of services, and a lot of money being piled into electronics and improving our homes. So, I think it's pretty incredible to see the NASDAQ up 40% when we had that drawdown just, 6-7 months ago. But I think what's really interesting is you consider what's happened over the last month and a half, 2 months. In this fourth quarter is it's been a very strong quarter, but it's kind of flipped that dynamic on its head. So as you look at the performance here in the equity markets, a lot of the U.S. growth and technology names are the dominant performers here. And when you look towards the bottom, some of those more cyclical parts of the market, areas like U.S. small cap companies, smaller companies, emerging markets, international developed markets, those are all the areas that kind of have lagged. Still very strong performance on a year-to-date basis, but they've actually lagged. And if you look to the investment grade, the fixed income markets, pretty substantial returns there as well. But as I flip to the next slide here, look at that top section in the equity markets here, and you'll see it kind of flips on its head. So Russell 2000, those small cap companies, mid caps, Japan and emerging markets, all those names that were down at the bottom on that first slide year to date, well, you've actually seen that they've had a very significant surge through the fourth quarter so far, in large part due to one, not only having the election kind of in the rear view mirror here and lifting a little bit of that uncertainty, but I think more importantly is what we've seen really on, I guess, 3 consecutive Mondays back in November was all this news around the vaccine. And that really does provide some light at the end of the tunnel here in terms of being able to see to the other side of this crisis. And I think that's a lot of what's going on within the markets right now. Yes, we're continuing to see carnage, unfortunately, with respect to the virus as it's kind of rolling through the country. But because of that dynamic, one, we have light at the end of the tunnel, but we also know a lot more about the virus. We know a lot more in terms of how to provide better care and improve patient outcomes. And that really does a lot of the heavy lifting to help markets look past that rough patch over the next few months in the winter months and look to the brighter future ahead. And I think that's exactly what you've seen reflected here in the performance in the fourth quarter so far, really reflecting that we're about to see the early stages of that recovery pick up momentum. And those more cyclical areas of the market are starting to be the ones that are being bid up the most as a result. So really some interesting dynamics at play, but the market's certainly pointing to that recovery and saying that it's not too far out on the horizon here.
Yeah, sometimes, Garrett, we need to be a little patient when we take a diversified approach, right? If we rely too much on a handful of stocks or one sector of the market, it's amazing how quickly these markets can turn. And the fourth quarter is a good exhibit here of how that can happen. And when they turn, they tend to turn sharply, either one way or the other. And this is what we've gotten quite a bit of in the fourth quarter. So as with many of the some of the diversifying asset classes, for example, that weren't performing for the first 6-9 months of the year tended to shift into positive territory and then also start to outperform in some cases the other asset classes that were doing well in the first 3 quarters of the year.
Absolutely.
So Garrett, that's great. Let's talk a little bit about get into a little bit about where we are with the economy. I think it's one of the neat things that you and your team over at Natixis have built is a tracking mechanism and what's become known of the many terms that we've learned this year, right? Whether it's things like contract tracing or positivity rates or whatever. One of the other items that we've learned is something called high frequency data points. I mean, that sounds like some sort of sophisticated wireless technology that you'd have in your home, but really it's been a tracking mechanism of what we do in our daily lives and as a measure of economic progress or regression as it was going back into the first quarter. Talk to us a little bit about what you're seeing here in terms of our, you mentioned how do we get back to normal. Talk to us a little bit about some of these activities that we ordinarily performed routinely prior to COVID and where we are with them today.
Yeah, so great question there. And it really has been an interesting shift in my daily job this year is moving away from some of those traditional economic indicators because the dynamics of the crisis, a lot of that data has just been coming out far too slowly. I mean, some of the more high frequency data we have is jobless claims coming out on a weekly basis. But the biggest issue is a lot of that data comes out on a monthly basis. By the time you have it in your hands, things have shifted so much that it's largely irrelevant. So we have used a lot of this alternative data to try to gauge, again, the pulse of the trajectory of the economic recovery here. And there's a lot of interesting dynamics. And I think, we have a whole slide deck of a lot of different data points, and it's probably some of which you've all seen, taking a look at how many travelers are going through TSA checkpoints on airlines. How many people are going out to dine in restaurants, pulling some of that data from the TSA, pulling that from the dining restaurants, from OpenTable in terms of reservations, a lot of different sources for some alternative data sets here. But I think when we kind of boil it down to what really matters here, I think it's really important to understand that the U.S. is a consumption-driven economy. The U.S. consumer drives 70% of growth. That's really what we need to be gauging here. It's how much are people going out about their daily lives, going out into the public, and actually going out and spending. And I think what we've seen is, as I mentioned earlier, some shifts. one of those shifts being away from services, more towards goods. Shifting away from, brick and mortar purchases to more e-commerce purchases here. So I think when we kind of look at a lot of this data, a couple of the slides that I'd point to here, just starting the first one of these data points is just credit card transaction data. And this has become far more available this year. It has been a very important data point that we're keeping a close eye on. And I think it's also really important and interesting to look at how that breaks down based off income levels. You start to think about different income brackets within the country. Well, those lower income brackets are actually the much more higher propensity to consume their incomes. They're pretty important drivers of consumption in the US. And so what we've done here on this first slide is just taking a look at what we've seen in terms of credit card transaction data relative to baseline levels, and that's relative to January 2020. Now, keep in mind, with a lot of this alternative data, it's not necessarily smoothed out like a traditional economic data. There's some seasonality at play. Whether or not January 2020 is the right baseline, you could certainly debate that. But the bottom line is it certainly does provide some insights as to the path forward of the recovery here. And this first slide, I think, is really important. As you take a look at different income bands, you can see, just generally that red line, total spending, we've recovered to just under or just almost to January levels of consumption patterns here in the US. So the consumer has picked up significantly, is still alive and strong. That's a very important driver for the US economy. And as I mentioned, as you kind of break that down by income baskets, low-income earners are actually above pre-crisis levels of consumption. So as you start to consider, well, are the shape of the recovery, that K shape that a lot of people have talked about, where the rich get richer and the poor get poorer. Well, you've actually seen that those low-income earners are actually spending above what they were before, and that's not necessarily because they're taking on debt. It's because of a lot of the policy response that we've seen this year, as well as the organic recovery in jobs through a large part of this year since the early months. So it's certainly an important dynamic. As we kind of peel back the layers of some of that spending, I think this is really interesting and gets to that idea of the shifting dynamics of consumption. We kind of broken out spending once again this is actually looking at a year-on-year basis, but breaking it out into some of these key areas, so retail, entertainment, travel, healthcare. We've made a heat map here. What is done well? Well, it's actually retail. People want to go out and buy goods. You can't go out and, spend money on services in large part. And you see that reflected in the entertainment section. People aren't going to movie theaters, even if they are open. They don't want to take on that risk. Very much limited in terms of, restaurants still, capacity constraints. Some aren't simply not open. Some have closed down permanently. Amusement parks, sporting events, you're watching football games with no fans in the stadium. So, it's pretty intuitive as to why we've seen these dynamics play out. And the net result is, if you actually take a look, and this is jumping back to your traditional economic data for a moment here, the personal consumption expenditures that the government releases. Well, if you actually look at goods consumption, we're now well above the trend level prior to the crisis for goods consumption. Services, not quite there yet. Still, we're seeing a recovery, but it's taking a lot longer. And that is in large part due with the persistent headwinds as a result of social distancing measures and trying to limit the spread here. So the bottom line is, a lot of that alternative data, there's areas of the economy that are going to continue to lag behind. And most of those are levered to the services side just because of the required human face-to-face interactions. But other parts of the economy are actually picking up the slack there. And in large part, it's the good side of the economy that's holding up very, very strongly. As we like to say, never bet against the U.S. consumer. The consumer, the American is really good at one thing, and that's spending paychecks. And you can see that really reflected here, and that's certainly helping the recovery in the U.S. economy as well. So it's been a learning experience this year with some of these data sets, but a lot of encouraging signs, certainly some headwinds, but a lot of encouraging signs as we start to look towards 2021.
Yeah, and as we look towards 2021, you mentioned that consumers, it's been generally interesting this year and somewhat rare, where even during this economic slowdown earlier this year and throughout the rebound, it appeared that consumers actually had more disposable income along the way this time around than in previous recessions. And we see that also with especially interest rate sensitive purchases such as new homes and auto sales as well. What have you seen there in terms of activity contributing towards those interest rate sensitive purchases like, say, mortgage applications?
Yeah, great point. So, first off, I think this slide here is a great way to kind of break down how powerful the policy responses has been. I think there's really two key levers, obviously the monetary policy side. And I think, some market participants put too much of the emphasis on the Fed and their reaction here. A lot of the heavy lifting, and in fact, in our opinion, most of the heavy lifting was actually done by the fiscal side. And if you actually take a look at the personal incomes, we've kind of broken down incomes based off the sources of those incomes. So one of the most interesting dynamics is early on in the crisis, actually April, when things really got very dark and gloomy, you had massive amount of layoffs and job losses. And yet you saw a massive spike in personal incomes. And you can see what that's driven by. One, that orange bar, those are the stimulus checks that were sent out. But also what you saw take over through, the early part of the summer is that green bar. That's the expanded unemployment benefits. Certainly we've seen that trimmed down over the last couple of months. But what you've actually seen is that those real incomes, excluding all the fiscal transfers from the government, real incomes from people going out and earning paychecks have started to recover. And that's the purple bars here. So really different dynamic in terms of this crisis, where you've seen that people are losing their jobs, but in many cases, people were actually making more than they were before as a result of the expanded unemployment benefits, as well as some of those economic impact payments through those stimulus checks. So a really important dynamic. I can jump ahead here in just a moment, but I think once again, kind of alluding to that dynamic of a K-shaped recovery. When we look at a lot of different indicators, I actually see a lot of data and evidence that suggests we actually are seeing that V-shaped recovery that some pundits were pointing to early on in the year. And I think one of the areas where we see that the most, as Chris alluded to, those interest rate sensitive areas, well, the housing market is absolutely on fire. And this is actually not anything new. When we were kind of building out our outlook for 2020, it was one of housing market strength that was going to help the U.S. economy probably outperform a lot of expectations. That story was simply delayed by essentially a couple months, maybe, if that. What you can see here on this slide is mortgage purchase applications. So this isn't just refinancings, and those skyrocketed early on as rates plummeted. And think about that. Well, that's certainly more money in your income as a result of less money being spent on your mortgage payments. So from people who actually already own homes, that's actually a source of incremental income through the crisis when you actually need it. So that's certainly helping to offset some of the damage of the crisis. But mortgage purchase applications, this is really critical. So we talk about the consumer being 70% of the economy. The housing market, when you add up everything, not just the home, but also, you have to go out and furnish that home. You have to maintain it. Maybe like now you're locked up in your home for 9 months working from home and you decide you want to improve on it. Well, all those consumption items add up to about 18% of GDP. So the housing market is also very much a critical driver of the U.S. economy here. And if you look at those mortgage purchase applications, as I said, excluding refinancings, we've seen a full V-shaped recovery here, and we're actually starting to tick even higher through, somewhat the seasonal low period for the market in the winter months. So certainly in mortgage purchase applications, the housing market is doing very well. And I mentioned some of those goods that you need to fill your home with. Same idea here. Some of those large, durable goods that you're going to fill that home with, you saw a huge drop off and a massive V-shaped recovery, and you continue to push higher here. So one of the areas that makes us more optimistic on the outlook for the economy next year, housing market has a big role in that because we're continuing to see significant strength there. The low rate environment is not changing anytime soon, and I have to say, I'm part of that millennial generation. Finally, we're doing something good. We're coming into peak household formation. That's a huge demographic that's going to be contributing to the housing market moving forward. And that's certainly a very big tailwind for growth moving forward in the next couple of years as well.
I like that. Household formation is the fancy word for get out of the parents' house. That's really good. Yeah, I like the technical term there. And like you said, that should make a big contribution towards our overall economic performance and GDP going into next year for sure. And markets themselves are a good tracker. Equity markets themselves are a great tracker for publicly traded, of course, companies. But sometimes we lose sight a little bit about small business, right? Small businesses have been particularly significantly impacted if they've been especially in those COVID COVID impacted sectors where it's been a real struggle. What are you seeing from a small business perspective? Because they're really the engine of getting our growth rates above a certain threshold. And it was really also a good measure of the health of our overall economic well-being. So you touch base on that and see what are you seeing in the small business arena?
Yeah, really important points. Small businesses are a critical employer in our economy, and I apologize. Looks like one of my charts here didn't want to show up on this slide here. But getting back to that alternative data set, one of the areas that we've been relying on quite a bit is this provider Homebase, and that's a utility for a lot of small businesses. They've actually been publishing a lot of data from small businesses in terms of tracking the number of hours worked by their employees, the number of businesses that are just open, and then just in general, how many employees are actually back to work. So this slide that you're looking at here is just kind of a pulse on those small businesses, and we can see it in aggregate. And I think the bottom line to take away here is that, when you shut down the economy, essentially in aggregate, you're going to see a significant drop off. That's exactly what we saw. You see that across all of these different businesses in terms of sectors, in business closures here in the bottom right. Not much of a surprise. What we did see, once again, is the early stages of that kind of V-shaped recovery. And unfortunately, as we move through the summer months and into the fall and winter, we've seen that flatline here a little bit. Part of that, I think, falls down in terms of not extending some of that fiscal support that we've probably needed. I am encouraged in recent days, not to fall into the trap that we've been listening to this going on 6 months now that, another fiscal support package is right around the corner. But it does seem like we are picking up some momentum here. And at the very latest, I would expect some support next year, probably, February, most likely, after the inauguration at the latest. That being said, we have seen a little bit of a flatlining here. In the bottom line, I think you have to take two different views in terms of that fiscal support. Right now, we're seeing a lot of signs that the economic recovery is self-sustaining, and that's going to continue. So providing that incremental fiscal support isn't really an issue at the macro level. The macro economy is going to continue to accelerate, and we're confident in that self-sustaining nature of it. The issue right now with fiscal is more of that micro focus. And so there are unfortunately going to be areas that are going to continue to kind of slip through the cracks here. I think some of this data here points to that. You're seeing areas in certain sectors that are really hurting the most. As you look at some of those business closures, arts and entertainment, certainly not doing so great. Some of the bars and restaurants and lounges, areas of the economy that are important employers, but, they certainly have gotten some support. But at a macro level, is it going to derail the economy and the recovery? It's not, but it's unfortunately a sad story of watching some areas suffer really needlessly because we do have that capacity for additional fiscal support. So it's kind of a mixed bag here. Yes, we have a self-sustaining recovery, but unfortunately we do need more. We'd like to see more. I do think we're going to get more. Is it enough? Is it soon enough? Probably not, but it's not going to kind of derail that macro picture.
Yeah, two things really can help small businesses out quite a bit. One clearly is additional fiscal relief and support along the way. Second is, hey, let's get a successful delivery of an implementation or a successful delivery of tens of millions of people with of one of the vaccine candidates and one of the vaccines, and that may also improve overall consumer confidence and the ability for someone to go into those smaller businesses to perhaps spend their money and get people back employed in those particular outfits. But one of the things that your team has also done is track the number of vaccine candidates. We've, of course, received some great news about three different vaccine candidates. One potentially may be ready for FDA approval in 2 days as it gets circulated, and certainly the coronavirus task force has indicated that they're ready to circulate millions of doses of the vaccine as soon as that approval from the FDA is final. But you've done some interesting tracking here of all the different vaccines and clinical trials that have taken place, and Why don't you give an update as to where we are with those, with that progress?
Yeah, absolutely. First off, I just want to make one point here on the small business side. One of the areas that we look at, one of the sources that we look at is the NFIB. And they put together this Optimism Index. And I think this actually has a lot of information. You know, Chris's point is very important. Fiscal is important, but so is that vaccine. And I think that's helped to provide a little bit of, as I mentioned, light at the end of the tunnel here. Unfortunately, in the short term, what we've seen is that Optimism Index, and this is kind of an aggregate of a couple different questions that go out to small business owners. You've seen that purple line. It's rolled over a little bit more recently. I think that reflects some of the issues that we've seen, you know, rising, targeted lockdowns, not broad, sweeping lockdowns like we saw in March and April, but targeted measures that certainly do weigh on some of that confidence for small businesses. But the caveat to that, or I guess the offsetting point, is as you look to the future, you're actually starting to see that plans for increasing employment tick higher. And that's an important sign. So people are actually starting to see that there is hope moving forward here, increasing plans to expand employment. And that's obviously an encouraging sign for small businesses. And I think a lot of that has to do with that vaccine backdrop. So as Chris mentioned, we've been tracking a lot of these vaccine candidates. And just generally what you're looking at here, and this list goes even further, we can only fit a certain number on this one slide. But I think, just looking at this slide, what we've broken it down into is just these bars showing the different phases of vaccine development here. And just one, the biggest takeaway for me is just the sheer magnitude of potential candidates here. This is really one of the takeaways that I don't think a lot of market participants put enough weight on with the dynamics of this healthcare crisis, is that I just in general, I have a hard time betting against humanity when we have so many bright people around the world all focused on one singular goal, which is to find a vaccine to help us get back to normal here. I have a hard time betting against that many people who are really focused on that one goal. And, I think what we've seen here is that there are a lot of very effective candidates. We've gotten some great news from Moderna, from Pfizer, AstraZeneca. Some of those results are a little bit less clear, but we also have another couple vaccines in the pipeline here. I think there's been concerns about how easy it is to implement some of these vaccines that need to be stored in very cold conditions. You need to have a series of 2 shots. There's some offsetting data where Johnson & Johnson is a single shot, may not require the same level of cold storage. We've also seen that even just the first shot of that 2-shot series is actually very effective on its own here. So a lot of really encouraging signs here. And I think when you look at the progress that these have made, we have 179 vaccines in development, 56 of those in human trials. And you can see by the bars here, we actually have quite a number of them actually in phase 3 trials. And we're kind of bypassing the normal approval methods, not necessarily giving up, any, taking shortcuts here, I should say, in terms of safety measures. But for, a lot of the early data suggests that these are not leading to any adverse reactions. Maybe there's some side effects to receive it, but not any serious concerns from a longer term healthcare perspective. That's really encouraging. And if you actually just look at historically what we see from vaccines that make it to phase 3, 60% of those generally are actually going to be formally approved under traditional FDA measures here. So what you can see is if you've actually made it that far along in the trial process, the dynamics of this crisis aside, that is a very encouraging sign that you are going to pass through to final approval here. Bottom line here is, yes, there's light at the end of the tunnel. There are significant efforts being made domestically. There are a lot of candidates abroad. And even just today, great headlines out of the UK where you're starting to see that Pfizer vaccine actually implemented here. We're certainly a lot closer to the end of this thing, and I think most people would have expected just a couple of months ago.
Yeah, it's a great point. I was surprised when I saw the list, right, of just how many participants were and how many companies were involved in the race to develop a successful race to go through a successful clinical trial of these various vaccines. So a lot of fascinating, hopefully optimism to look forward to as these vaccine doses get circulated throughout the country. With that, I'd like to shift the last section into a little bit into politics, Garrett, if it's okay with you. We have an incoming, most likely an incoming administration here with in the Joe Biden White House, and with this, I guess, anticipated split Congress, right, where you might have, it appears, yes, the Democrats held the House of Representatives, but their majority is very slim. In the Senate is up for grabs in terms of control. We'll find out after the Georgia runoff elections in early January as to who's going to control the Senate chamber. And you've done some interesting things with navigating through what the potential policy impact was prior to the election to perhaps what is more likely to occur with this type of political arrangement. Why don't you talk about what your team has found there?
Yeah, absolutely. So, this slide that I'll pull up here, there's a lot going on, and that's because there's a lot that goes into a lot of these presidential agendas and platforms. But we kind of built out a framework for what are the most likely policies that would be put into place under potential outcomes from the election. And obviously, as we made our way through September and October, a lot of those expectations shifted quite dramatically. And then obviously on election day and week, I should say, that shifted a lot. So I will say there is still some uncertainty with respect to, as Chris mentioned, those Georgia runoffs. If the Democrats are actually able to seize those two seats, that's a 50-50 split, and the tie goes to the VP. So Kamala Harris would have the deciding vote there. What I would say in terms of some of the policies here, though, even with that potential, I think a lot of those more progressive policies are probably off the table here. And so as we look at this one slide, I'll pick out a couple of the ideas, but as you look at it, just generally, you'll notice we have a lot of text here in black with a line through it. Think of that as some of those measures that just without having that blue wave dynamic, with the Democrats really seizing a firm majority within the House as well as the Senate and taking the White House, those are probably off the table, at least in that incarnation and those expectations. Some of the red items are probably what we're more likely to see. And the basic gist here is that without having full control of Congress, it's going to be very hard, even with that type of dynamic where you have reconciliation pushing through, avoiding the filibuster and getting some of these policies through. That's probably going to be hard to do. A lot of these measures are going to have to be more centrist to pull over some members from the opposite party, reach across the aisle, or what we're likely to see is some of these addressed through executive orders. So as we kind of go through the list, what were some of the biggest concerns that from a market participant perspective, the investors had? Well, I think at the top of that list, it's pretty obvious. Corporate taxes moving up, and then the personal income tax. A lot of people were concerned about the impact of that. We had a little bit of a different take on that. There were a lot of offsets to some of those increases on the tax front, most importantly being the infrastructure package. Those essentially were paired hand in hand. So yes, you're increasing taxes, but you're also planning to spend quite a bit, north of $2 trillion, almost $3 trillion. That's a massive amount of money that funnels into the economy and does funnel into corporate earnings. Well, those are probably off the table, at least in that form. Maybe we get some sort of infrastructure deal. There's long been bipartisan support, but never been able to quite get it across the finish line. In the early stages of recovery next year and into 2022, maybe we get that. Bottom line, I think the bigger takeaways for us, healthcare, probably going to see that as opposed to, changing significantly the Affordable Care Act, probably going to be much more targeted just on some of that drug pricing. And as we walk through some of these other items, think of how typically it works for a first-term president. Generally, you'll have a little bit of leeway in terms of your first term and really in that first year to push through some sort of policy that's going to kind of define who you are, who your presidency is, what your presidency is. But I think what that's going to be focused on, or what you're going to see a large part of that focus on, is probably seeing trade. You're going to see a shift in that narrative. It's not going to be quite as, aggressive. It's not going to be a go it alone. It's going to be a much more bilateral, multilateral approach, trying to bring on much more, restore relationships with U.S. allies and address China that way. probably a little bit of a rollback in some of those tariffs. Not going to be a wholesale reversion back to pre-Trump era, because the hawkishness against China is certainly bipartisan, and Biden is certainly a China hawk, as opposed to what some political pundits might lead you to believe. A couple of the other areas to keep an eye on: energy. Probably going to see some rollbacks of and through executive action, more regulations put back into place. Some of the restrictions that you saw Trump roll back. On technology, there's a lot of concerns of breakups. It's probably going to be focused a little bit more on privacy protection, although there has been some growing concerns about some of these very large, big tech names and potential breakups. That, if it does come to pass, is probably a much further out agenda item. It's not something that we would expect to see in the short term. And then in terms of the last couple items here, immigration, we've already started to see some movement on that front. Probably going to continue to protect DACA, increase pathways to citizenship, and keep in mind that's actually important for U.S. growth. Demographics are a big driver of growth, and immigration is important. Immigration policy is important to get right. You want to be bringing in talent that helps to grow the potential growth in your economies, and so that's an area that certainly is important to address. And those are really the key items, I'd say. A lot of the left progressive agenda items, and even some that are even a little more centrist, but bigger in scope, probably just off the table in the event of the expectations here for a split Congress, and even in the event of the Democrats getting that 50-50 split with the tie going to the VP, probably not going to be seeing a lot of game-changing policies put into place.
Yeah, thanks for that, because that's been we asked folks when they were registering if they had any advanced questions to share your way, and this was a big one, right? We're looking out at a field of not just individuals, but also in many cases small businesses, small mid-size, and even some large businesses out there. Questions about corporate tax rates, questions about capital gains tax rates. Right, that perhaps after 11 years, for example, of investment gains built up in a portfolio, is this the time, right, to take a look at whether or not those important metrics are changing. So this is a very interesting, busy but very interesting summary, right, of how things can change so quickly with such a unique election like we had this year, where the chambers of Congress kind of got the margins of the majority were slimmer, and we also, of course, having a new White House regime coming in next month. So lots of interesting things to look forward to in 2021. Along those lines, we also received some questions about the potential impact on the regulatory side as it relates to retirement plans. And of course, we've got a lot of people on the line who govern and oversee retirement plans. And with potentially with a mixed Congress or split Congress and a logjam of a legislative logjam, you might conclude that a lot of things may be done through regulations or the regulatory body through the executive branch. And one of those areas that could be impacted certainly is retirement. And as that does appear to be, that concept of retirement does seem to be an area of bipartisan appeal, despite all the bickering that happens in Congress. So look forward for us to bring forward to you a summary of legislative and regulatory items for consideration into 2021. So with that, I'm going to turn it over to James Jaramillo quickly, see if we have any questions coming through in the Q&A.
Thanks, Chris. We currently have no questions in the Q&A.
Great. Well, I appreciate everybody spending their time with us today. I appreciate sending the questions in advance. And Garrett, we certainly appreciate having you today. We packed a lot in a modest period of time here, Garrett. So we really appreciate your time and the slides and the information that you've shared with us today. Thanks for being with us.
Well, I really appreciate it. Thank you.
And wanted to say to everybody, I hope you have a very happy and healthy holiday season. And we look forward to revisiting with you, whether over video conference or in person in 2021, and looking forward to those dates. So Thank you for joining us, and we'll see you next year.
Thank you. Take care.